You'd think that after the 2008 financial crisis, we'd have this all figured out, right? I mean, the world's banks got buried under an absolute mountain of new rules, all designed to make sure that never happened again. And yet, here we are. Massive, system-shaking bank failures keep happening. So what are we all missing? Well, it turns out regulators now believe the answer isn't in another 1,000-page rulebook. It's in something much harder to pin down: human behavior. 87 million pounds. That's a huge number. And it's the record fine that got slapped on Credit Suisse in 2023 for what regulators called, and I'm quoting here, significant failures in risk management. It was just this glaring reminder that even a decade and a half after the last big crisis, something is still fundamentally broken inside some of our biggest financial institutions. And that really gets to the heart of what we're talking about today. We've got more capital requirements, more stress tests, more oversight than at any point in history. So why do we keep seeing these headlines about catastrophic bank collapses? The old solutions, they're clearly not enough. And that's forced regulators to go hunting for a completely new culprit. For years, the thinking was pretty straightforward. If you just make a bank's balance sheet stronger, force it to hold more cash to absorb losses, you could prevent a crisis. But what regulators have come to realize is that this is kind of like treating the symptoms of a disease, but not the disease itself. It doesn't actually stop the crazy risk-taking that leads to those massive losses in the first place. And this, right here, is where the entire game has changed. Global regulators, I mean everyone from Frankfurt to Sydney to Toronto, they've all zeroed in on this invisible but incredibly powerful force they believe is the real root of the problem. And that is a bank's internal risk culture. They're arguing that it's the culture that really drives behavior, for better or for worse. So what on earth is risk culture? Well, the Institute of Risk Management defines it as the shared values and attitudes about risk inside an organization. But I think it's easier to think of it not as a formal policy, but more as the collective mindset, right? It's about what people do when they think nobody is watching. It's those unwritten rules that determine if managing risk is taken seriously or if it's just seen as an annoying bit of paperwork you have to get through. Probably the best way to wrap your head around this comes from the Dutch central bank. They use this brilliant iceberg analogy. So, the very tip of the iceberg, the part we can all see sticking out of the water, that's behavior. These are the tangible things, right? The trades being made, the loans getting approved, the reports being filed. It's everything you can see on the surface. But, of course, just below the water, there's a much, much bigger piece. Group dynamics. This is all about how people interact with each other. Is there a herd mentality where everybody just follows the leader without question? Do different teams actually work together, or do they all work in their own little bubbles? And here's a big one. Can a junior employee actually speak up and challenge a bad idea from a managing director? These dynamics are what shape the behaviors we see up on the surface. And that brings us to the deepest, biggest, and honestly, the most dangerous part of the whole iceberg, the mindset. These are the deeply held beliefs and assumptions that guide the entire company. Is risk seen as something to be carefully managed, or is it just a bureaucratic hurdle you have to jump over to get to your big bonus? This invisible foundation, it determines absolutely everything that happens above it. Okay, so if culture is this huge, invisible, underwater force, how in the world can you possibly regulate it? Well, regulators aren't just throwing their hands up in the air. They've actually developed a remarkably consistent playbook to try and figure out what's really going on beneath the surface. In this playbook, which is laid out really nicely here by the Institute of Risk Management, basically asks 4 key questions. First up, what's the tone from the top? Does the leadership team actually walk the walk or just talk the talk? Second, what's the governance like? Are people actually held accountable when things go wrong? Third is competency. I mean, do people even have the right skills for their jobs? And finally, decision-making. Are choices being made with a clear view of the risks involved, or is everyone just focused on the potential rewards? Now, what's really amazing about this is the incredible global consensus. Just look at this table. You've got the ECB in Europe, the FCA in the UK, APRA down in Australia, the New York Fed. They're all looking at pretty much the exact same things. Tone from the top, accountability, incentives. It's so clear that this consensus formed because regulators everywhere realized that just writing more rules completely failed to stop the 2008 crisis. They all came to the same conclusion. It's the behavior that's the problem. This isn't some niche academic theory anymore. This is the new global standard. And this isn't just theory either. This is how it works in practice, and it's brilliant. This is a real tactic used by the European Central Bank. They literally send a supervisor to sit silently in the back of a board meeting. They're not there to check off boxes on a compliance form. They are there to observe the culture. Are people actually challenging each other's ideas? Is there a real debate? Or is it just a room full of people nodding along? It's a fascinating, direct way to peer below the surface of that iceberg. So we've seen the playbook for what good looks like. Now let's look at the real-world consequences when these cultural elements fail. Because these aren't just abstract risks we're talking about. They lead to very real and very damaging outcomes. First, let's take a look at General Electric. Now, it's not a traditional bank, but its financial arm, GE Capital, faced a crisis that was completely rooted in a cultural failure of governance and transparency. The big problem was a serious lack of openness. This wasn't just, poor communication. The SEC found there were continued failures to disclose absolutely critical information to investors.
And that failure led directly to massive financial losses. So you can draw a straight line from a weakness in the culture, a failure of governance, to a devastating outcome in the market.
Then, of course, there's a name from the very heart of the 2008 crisis, Bear Stearns. This was a textbook case of a toxic mindset. When people went back and looked at what happened, reports showed that risk management was basically treated as an inconvenience, just an annoying roadblock on the path to bigger profits. That mindset was so catastrophic that the firm's collapse was one of the major triggers for the Dodd-Frank Act, a huge piece of legislation designed to force the very accountability and transparency that the culture at Bear Stearns so clearly lacked. And just to prove this isn't all ancient history, let's talk about the 2023 failure of Silicon Valley Bank. The Federal Reserve's own report on the collapse blamed a fundamental failure in the decision-making element of their risk culture. What's really shocking about this one is that they weren't brought down by some super complex, exotic financial product. Nope, their leadership simply failed to manage one of the most basic, fundamental risks in all of banking. What happens when interest rates change? It was a complete and utter failure of risk-based decision-making, right at the very top. So what does this all mean for the future of banking? Well, it signals a really fundamental shift in how we think about financial safety. The old model, where regulators just write more and more detailed rules, that's being replaced by a new focus on ownership and personal accountability. So what's the big takeaway here? It's that regulators are basically saying, look, we can't just impose a good culture on you with a rulebook. Instead, accountability has to be personal. Bonuses can't just be linked to profits. They have to be linked to good conduct. Senior managers need to have skin in the game, so their own money is on the line if things go wrong. And ultimately, the responsibility is shifting away from the regulators and squarely onto the bank's own board of directors. It's on them to own, manage, and answer for their company's culture. And that kind of leaves us with this final, really challenging thought. This focus on culture makes perfect sense, right? But it's also incredibly difficult to pull off. I mean, how do you measure a mindset? How do you put a number on a belief? The big question for the future is whether regulators can actually identify and fix a toxic culture before it leads to a crisis, or if this new approach will still always be one step behind the next disaster.